we help them create a little bit more of a strategic investment allocation that really helped to manage a lot of the volatility that we've obviously been seeing lately. Afternoon, we have a calmer week here in data with obviously a pretty big focus still on tariff news ahead and a big week looking forward as we wrap up April here heading into next week. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal is to always leave everyone feeling more empowered after every interaction. And our kind of objective here on these Thursdays is to bring to you the market news, the data, the trends we're watching, and hopefully weed out some of the noise along the way. And we do have a couple data points to cover, but it was, again, a little bit lighter on the data side here this week. Obviously, a lot of focus on the tariffs, so we'll talk about that. But get ready because coming up next week, we have a lot to cover. So I'll start out with a couple data points. First, I'll mention Monday, we had U.S. leading economic indicators come out, and that number showed expectations being down, or sorry, the number came down 0.7% versus expectations of negative 0.5%. So a little bit further down than the expectations, and certainly compared to the last read. This is important to watch, but it doesn't tell the story necessarily, right? This is not a predictor, so just keep that in mind. Yesterday, we also had new home sales come out and was actually up quite a bit, so 724,000, up quite a bit from not just expectations, but also the prior month as well. So we'll continue to watch the home sales data because this is a story that's been going on for quite some time at this point. But we'll spend a good amount of time here this week focusing on two things. Number one, we'll spend some time on the tariff updates. And number two, we have a great question of the week, which we're actually going to do as more of a case study here this time from a recent new client conversation. So before I get into that, let's talk a little about the tariffs. I'll share kind of the news story updates, and then we'll talk a little about what markets have done to react to it. So on Wednesday, Trump had shared that China tariffs will come down substantially. I will share prior to that, China warned on Sunday that they would hit back on any countries that made a deal with the U.S. So the question, as you start to see how some of these stories might all kind of translate together, is where's China going with this is the big well, I guess the question is, where are we both going with this? But where is China going with this? Does this mean that they're trying to get more folks on their side? Does that mean they're maybe creating more enemies and more countries will work with the U.S.? That all remains to be seen, but I think that, you know, our kind of general theme has been that could be what ends up squashing all of this, because if we're just tit for tat with China all day, I don't know how we necessarily get to a good resolution. So it's possible that either the US or China might, you know, kind of team up with some other countries and put a little pressure on the other, which may be where, you know, things start to shape a little bit in terms of a deal. So again, that was on Sunday. On Wednesday, Trump shared that China tariffs will come down substantially, and so this eased a lot of concerns. Bessent shared throughout the day that there were opportunities for significant trade deals with China. But then fast forward to today on Thursday, and China came out and basically denied any suggestion that they're in talks with the United States. The takeaway, obviously, of this is that it looks like they may not be as willing to play ball, or at least not publicly. So we'll have to see where all this goes from here. But obviously, this is a big topic of conversation. And again, I think this is where some leverage with other countries might be what ends up, you know, kind of solving this issue, and hopefully sooner than later, because obviously with the unknowns out there, there's a lot of angst, right? Now, what I will share, though, is despite the most recent news, in general, markets are actually up pretty strong over the past week due to some of this trade and tariff news. Obviously, some softening on the US's side of it, which is what the markets have really been concerned about. So hopefully that kind of trend continues. But overall, given all the news over the last week or so, again, markets are up pretty strong over that past week. Coming up, be sure to tune in. We have so much to cover next week. So we have consumer sentiment tomorrow. We kick off jobs week. And we get inflation and the Q1 GDP advanced estimates. So a lot to cover next week for sure, and especially with inflation, how this translates to the Fed conversation at the moment with all the pressure being put on Fed Chair Powell and interest rates. So before we break this week, I do want to kind of switch gears a little bit this week again and do a bit of a case study. So more recently, we had a new client that came to us the other day. And this individual had done a great job of saving. They were really looking for an advisor to help ensure that their investment strategy was aligned with their longer term goals and help a lot with tax planning to not just enhance their own savings and how much impact they could make and, kind of live out their retirement, but also how this might translate to inheritance down the road as well. After digging in quite a bit further, we came to find that they had assets pretty equally split between kind of pre-tax IRA, Roth IRA, and brokerage account assets. But their general risk tolerance, they were kind of right in the middle, kind of a typical, 60-40 type of strategy. But what we found is that their allocation was really the same across the board in all of those accounts. Now, that was where they felt most comfortable, but every single account was structured that way. And they were in retirement, so they were really looking for an income strategy, but obviously didn't want to give up the growth of the long term over the years. So what we did after kind of bringing this back to the drawing board and putting together some strategies is we helped them create a little bit more of a strategic investment allocation that really helped to manage a lot of the volatility that we've obviously been seeing lately, but also to set up the allocation by the account registration. So they were pulling primarily from their IRA to help kind of reduce future required minimum distributions. So although our total allocation recommendation still kind of fell in line with a general 60-40 mix, although we have some additions in there given the environment we're in today, but generally speaking, that's kind of in alignment there. What we did is we allocated more of the income producing assets to the IRA side of it, right, where they were actually drawing money from so that they could kind of create that income stream. And then we allocated more of the growth-oriented assets towards the Roth, more specifically, to take advantage of some of those long-term tax benefits with the tax-free growth that, of course, does occur in those Roth assets. In addition, again, they plan to hold the brokerage assets for the long term, and the inheritance side of things was important. So the Roth will help with that for sure if they don't use those funds, right? That's going to be tax-free. But second is with the brokerage assets, they don't, again, really plan to use those necessarily and really plan to hold those long term. So what we did is we set up an allocation that is more growth oriented, but still long-term focused. And that allowed us to basically set up a strategy that won't require a lot of trading, a lot of in and out, so that if that money is not used and does go to kids in the future, it actually may reduce the total tax impacts because of the ability to take advantage of a step up in basis at that point. So I thought this was really, really fun, something we may, continue to do if this is helpful, but certainly something we run across quite a bit, actually. So this is pretty common in some of the things that we help clients with. But hopefully this gives some ideas for yourself and some things to consider, especially with everything going on in the markets now and how you might still look at your total picture the same, but maybe allocate differently by account to take advantage of the different registrations. Okay, so with that, we'll break for the week. Again, be sure to tune in next Thursday because we have a ton to cover with, again, consumer sentiment, jobs week kicks off, inflation, Q1 GDP advanced estimates, and some things in between. Obviously, we'll share some tariff updates along the way as well. In the meantime, have a great upcoming weekend, and we'll see you next Thursday at 3.